Good evening. Let's talk why land. Let's talk why today. My name is Justin Sleva. I am the fund manager for Pasture Holdings, along with my partners Trevor Probant, Josh Biesinger, and Beth Pianori. We're glad to have you on here. We see some familiar names and some familiar faces on here. So good to see you all tonight. As we walk through this, I'm going to ask a couple things. You can ask questions as we go through this. We were going to come back and answer them at the end of this webinar. There will be a replay available, so you can watch this again. And we are going to talk about an offering that we have right now. So buckle in, be ready for those questions and answers. We're going to walk through, again, why land, why today. Who is Pasture Holdings? We're a new syndication team, but not new to land. Pasture Holdings team is an independently seasoned land investors and developers. Our experience includes everything from residential house flips to wholesaling to syndications to raw land to development. We've established Pasture Holdings in 2023, and this is after us collectively as a group have developed 4,300 acres together. So we've done joint projects together, over 21.6 million in revenue. And our first offering went full cycle in 82 days with a cash on cash return of 13.5%. It's a pretty good return. Here is a picture of all of us, a little bio. I'll let it sit there for a little bit so you can kind of get a feel for us. And we're going to talk to Trevor Probant. Is going to kick it off, and you can kind of get to talk about his passion for land. And you may have recognized his voice from the Dirt Road to Wealth podcast. It's one of my favorite names for podcasts out there. So, but you got myself, fund manager, Justin Sleva, Trevor Probant. He's our chief marketing officer. Josh Biesinger, chief operating officer. And then Beth Pianori, she's basically the glue that holds us all together in our wild ideas. Trevor.
How's it going?
Good to see you, man. Thanks for
Good.
joining.
I need to get the camera. If you need to allow me to do that, if you want to.
Okay. All right.
So, anyway, we're talking about land investing. I know everyone's kind of done a little bit of everything, probably in different types of real estate and everything. But land is really the oldest and most sought after form, right? Like we started subdividing land and banking based on land, right? Most common or well-known alternative real estate investments that a lot of people deal with that they see all the time is going to be single family. They're also going to do a lot of multifamily apartment syndications, right? There's pros and cons to all of that. And there's pros and cons to land, right? We're going to talk about that, good, bad, and ugly on that. Commercial investment projects, if you know anything right now, especially office, is taking a beating. We are we're seeing that on the news every single day, and that's something that we are able to not have to deal with, and we're very, very thankful for that. Right, the last few years we've had a giant run up on prices of commercial real estate, especially office, and after COVID-19, this is a whole new world as far as that's concerned. What we really, really love about it is land is the backbone of all real estate transactions, right? The house that you're sitting in, the office building you're sitting in, the apartments that you're sitting in, the coffee shop that you're in is all built on land. And so we've got multiple different ways that we can bring that land into a higher and better usage. This is just part of kind of what we do. So, Justin, get the next one, please. A couple different ways we do this, right? Many understand investing in apartment complexes, commercial building projects, even a residential house flip. But what are your options whenever it comes to land? And this is just our version of land, right? Land can mean a million different things to a million different people, but this is what we're talking about today. So the debt investments, land-backed notes, right? Very similar concept to buying mortgages, easy to resell assets in the case of a default, right? This is kind of what this whole presentation is about. Is going to be talking about the debt investments that we're coming in on. This is buying and trading and selling notes, right? Mortgages, deed of trust, depending on where you're at. But this is the biggest opportunity in real estate as far as I know. And we'll talk about kind of why, but this is like the giant opportunity when it comes to real estate and when it comes to land, right? Also, what we have is the equity investments, right? That's land development or subdivision. This is a force appreciation game. My dad coined the term buy by the ranch and sell it by the pasture, right? We did that. He did that a long time ago. My family's been doing this since the late 80s, early 90s. They've done nearly 60 plus thousand acres of development by doing the simple subdivides, right? Both recreational and residential kind of stuff. But that's kind of what the sexy part. But what we're really talking about is much bigger than that. So, Justin, why land today, right? Post COVID America. It has, as we've all known, it's allowed people
Hey,
to.
Trevor, you can
Yep.
hit camera now. Sorry to interrupt you.
Okay, no worries. Sorry, guys. So, what it's allowed us to do is it's allowed people to no longer have to work within the confines of urban America, right? I'm living out on a couple of acres out here and grew up on 4,800 acres. And what people have realized is when you didn't have to go to an office, when you didn't have to go and fight the commute every day, we've realized that the real value in life, really, after we've lost so many people and the people that we cared about when it came to COVID, we realized what's important. And when it comes to family and when it comes to quality of life, that often means to many, many people, especially the folks that are older or have families, especially children, they've realized that now that they want a piece of the American dream, which is to have a little room to use and raise their children on, right? Big, big deal here. I've got a wife that loves to talk about all the homesteading trends, right? This is a huge deal with the mothers of America as far as chickens, right? Everybody wants their chickens, everybody wants their small cattle, things like this. We're going back to kind of a more simple times, and I think it's absolutely fantastic. The thing is in order to do that, you have to make it affordable, and that's something that we'll talk about here in just a little bit. The same thing, right? Like what destroyed the commercial real estate market has been a boon to what we do. That's already kind of self-explanatory. Across the entire U.S., land prices have doubled in the past 10 years. If you've looked at any land in your areas, it's probably done much more than that in the last 10 years. But we're just taking the overall price of stuff in Elko, Nevada, and the stuff outside of Austin or, LA. Yep, many areas that we invest in, we focus on the really good parts of Oklahoma, but especially Texas, right? Where we continue to have a huge influx of businesses, thus jobs, and it's doubled in value in the past 3 years in many, many of the areas there, right? Demand is there, but with rapid land value appreciation, how do you maintain affordability, right? That's the key of everything that we do when it comes to this. So, Justin. This is just a kind of a cool little chart, right? This is something the Texas A&M came up with, and this is talking about 2012 to 2023 Q1, right? This is the real costs, the real prices of land sales in the state of Texas. We work in a lot of these markets that are now 20 to 30,000 bucks an acre, but you kind of take the overall over the entire size of the state of Texas. But the one cool thing that you can see is this trend overall, right, is high and to the right, but especially the last few years. And in the markets that we're focusing on, we believe that's going to continue, which brings about the whole affordability, right? The big stuff is no longer affordable for normal people, right? Non-trophy assets. And so that's where the demand is, and that's where the opportunity is. All right, Justin. Pastor, how we're working on the affordability, right? Decrease of demand, just like we talked about, skyrocketing land prices. And so we've gone through this giant opportunity where generational wealth has been built on a system of business, which is animal husbandry, which I'm a 5th-generation Texas rancher, and we can't make any money raising cows, right? We run Black Baldies. We used to be Beefmaster cattle. We ran for 30 years, but like I said, we've always ran stock since 1929. We can't make any money at it, neither can anybody else, right? As primary producers in animal husbandry. Because of that, most of these folks are selling out, are older. The average age of a landowner in this country is 66 years old, right? And most everyone can't make money enough to feed for one family, much less two families, right? Generational wealth. So now we have a entire group of landowners who are aging out and they need to sell. The thing is because these prices have gone so high, no one can afford the big stuff. And that's where we're talking about this. What again, buy by the ranch, sell by the pasture, right? This is an example here of Sulphur Springs 40-acre tract that we did, right? A subdivision of 37.4 acres into 3 affordable lots. It's the most basic thing you can do, right? You can buy a case of Cokes cheaper per Coke than you can when you're buying it, buy the Coke, right? So what you're going to be able to do is you're going to be able to buy this, say, for $7,000 an acre, right? We spent some money on cleanup. We spent some money running some power or running some water. Nothing crazy, but now we're able to sell this at $12,390 per acre, and the overall cost for this, say, 12-acre tract makes it affordable. And because of that, this is the one that Justin talked about at the very beginning that we sold in 75 days. So that's just a kind of an understanding of where land is going, why we are focusing on the markets that we're focused on. So pasture holdings, let's talk about that, right? 3 pillars of subdivision, or what we call a subdivision, a simple subdivide, right? It's not a true subdivision. Most of these are what we call a rural subdivide. We have 3 pillars. This is taught to me by my dad, uncle, granddad, right? Access. We don't buy stuff off of dirt roads. We always try to buy stuff off of paved county roads or state highways. Paved county roads are even better because we don't have to deal with TxDOT, right? Power. We work usually with smaller rural power co-ops. Not always. We've got one that the power co-op is the AEP came in and did one, and they ran the power for free for us as part of their capital expenditures for the year, and we brought them 15 new customers. So it's usually an easy conversation. It just depending on the cost that you're going to incur whenever you're running the power, right? Water. This is something that's often overlooked, and poor operators overlook it all the time. And if you don't have water, you're not going to have people there, especially when it comes to residential usage. There are properties out in way West Texas that are used for recreational usage, hunting. Someone runs out and runs a generator and a camper, and there is a market for that. We do not focus on that market whatsoever. And so we have to know that we're either going to have rural water, right? Or if we're going to have really good water underneath us to drill water wells. So that's obviously all 3 of those are important, but water is very important. So that's our whole deal, right? We want to build great quality assets that people want. And we don't cheap out on stuff. We make sure that it's priced reasonably, but we want the best product that we can possibly have when it comes to competition in any particular marketplace, right? We want to feel good, and we want the people of the county that are living there to feel proud of what we're doing. So offering owner finance, here we go, to land buyers when mainstream banks will not lend on another opportunity to satisfy a high demand, right? The Wells Fargos, the Chase banks, all the Main Street banks that you've ever dreamed of, nobody wants to touch this stuff. There's multiple reasons, but the main reason is because Wall Street doesn't know what to do with it. It's harder for them to put into their little little algorithms that they come in and buy all these tapes and notes whenever they package all these things together. That is the real answer. If the banks had a really good buyer on Wall Street, they do it all the time.
Yeah, he's exactly right. Ever tried walking into Wells Fargo and ask, "Hey, I'd like to buy some land. Can you give me a note?" They look at you kind of cross-eyed. So, like you said, there's a perceived risk for higher default with land. It's just they don't see the value add in it as we do. So, what we've come to find in this sub-market of the 150,000 and less, there's billions of dollars in equity just trapped there, waiting for somebody that can be an operator that can take these bigger parcels, bring them down to that size of affordability that can offer the owner financing and pass it through. Landowners are often able to sell the vacant land by owner financing, and Pasture Holdings originates the purchase of promissory notes from landowners across the United States. Right now, in our passive income note fund, we're buying notes at under 75% of unpaid balance. Our average price is that we have into the actual note itself is 65% of market value, meaning we have an instant equity of 35%. You know, an example of our internal KPI, because we believe that KPIs are going to guide us and make sure we're on track with everything, is at purchase price of 70% of the unpaid balance, and right now we're at 56% of market value, and that's right now generating cash flow for us, and it's been doing that since August of 2023. So there's a couple things. Trevor kind of hit on the three pillars, but a couple things we look when we're buying these notes and we're underwriting these deals is access, our utilities in place, geographic markets, comparable tract sales, attributes, and can we buy it for less than 75% of the unpaid balance? This checklist it's what we demand in our product. We don't just say yes to everything because we want to provide good notes for us to have for our investors to get that passive income that they want. So I'm assuming since you're here, you're probably a accredited investor and you're wanting to learn more about it. And, you know, as a real estate investor, you have choices. And one of those choices that we get compared a lot to is apartment syndications versus a land investment. And, you know, I want to go down the good and bad of kind of both of them and and just have an open conversation about it. Because, you know, one thing you'll find with the Pasture Holdings team is the transparency is unparalleled of what you're going to see. We keep it extremely simple because we like simple. It's easy for us. So apartment syndications right now, you're seeing anywhere from a preferred rate of 6, 8, 10%. The distributions come based on cash flow off the rent rolls and different value adds. Their fee structures, if you've ever looked at how a syndicator, a GP gets paid, it is so confusing. Between our group, we did a kind of an audit between our team here, and we're in about 22 syndications right now. I know it's 20 for sure, but we think we had 2 more that were there as well. But I'm going to say 20 plus syndications. And everyone sold us the same thing: depreciation and in cash flow. So that we walked into this thinking, you know what, we're going to get all this depreciation, we get all this cash flow. For us as real estate professionals, we're able to take the depreciation. The bad thing is if you're not and you're a W-2 employee, that depreciation is just a buzzword that's not really going to affect you much, and you continue to roll it over in hopes that they have a capital event and you sell and maybe you get it then, but you know you typically don't eat it up with your W-2. And the time in a syndication, you know, you are typically hey Nathan, we got your question there. I'm going to get it to you at the end, okay? And then time capital tied up is usually years on a syndication, like in a multifamily syndication. You know, vacant land, what we've put together is basically everything that is what we don't like about apartment syndications or syndications, the commercial syndications we've been in, and put that into a land investment that we think would be attractive to accredited investors. So our preferred rates range from 10 to 11% depending on your hold time. Our distributions are simple. There's no maintenance costs hidden in there. There's no management fees hidden on the back end. We make our money negotiating the rate on the backside. And so there's nothing to hide there. We arbitrage a difference based on the yield we buy on. So we believe the product in the product we're buying, because that's how we get paid, is that arbitrage there. There's no depreciation, which, you know, there is some tax benefits. If you're a foreign investor, you can use some different tax things there, and we can walk you through that outside of this call. But, you know, that depreciation, that shiny word. If you're a W-2 employee that is an accredited investor, you're not going to see that depreciation you would with the apartments. And then the time capital tied up. This is probably one of the coolest things for me as a fund manager and getting to discuss it is you get to choose 6 or 9 months. Now we'll continue to let you be in it, but it's kind of like going to get a CD at 10% or 11%. And then you say, hey, Justin, keep my money working. I like my paycheck on the first of the month every month. Me and Trevor say, yes, sir. We keep it in there and we keep rolling with it. And that's, you tied up for an indefinite period until they decide to sell or refinance, or know that, hey, every 6 months I can pull it back out, or every 9 months, depending on the term you chose, you can pull it back out. So, that's a good thing for me. And that's heads up straight from it. There's no trickery behind it. Like I said, we keep it super simple for that. Why are investors turning to land? Because the market has just screeched to a stop. It's halted because of interest rates, and you have trained experts is what I'm going to call them, because I don't know how many of them have operated a lot, but they got into this season of low cost debt, and they're using a lot of leverage to make these deals work. And so if they don't get the appreciation, if they don't get the rent raise, if the rate raises on their debt goes up, the cash is gone. And we're getting what we get told, cash preservation mode. And again, we built the passive income note portfolio to be the opposite of that, because we wanted you to know that on the first of the month, you get that check. Where we're seeing this cash preservation mode across our funds that we've been a part of other syndications in. And it's a little strange when you want that 8 to 10% preferred paying you monthly or quarterly, whatever you agree to, and it's just not there. And then we're seeing increasing fee structures and cash calls coming up, and that's something you're going to hear a lot in the syndication world, is cash calls for these apartment complexes, because they're hemorrhaging cash and they need to stay into it, and there's not the buyers at the rate that they want because the interest rates are so high. So the allure, we talked about the allure promise, tax depreciation versus the reality of it. I'm not going to beat that up too much, but make sure you understand what that really is versus just what you saw on Instagram or saw on TikTok. And then complex fee structures. I go cross-eyed looking at the fees and how they're paid. And it's crazy to me that a GP can be paid on just purchasing it, then managing it up front, and then some other little fees up front. So they're paid up front for getting the deal, and it hasn't even performed yet. We believe at Pasture Holdings to get paid on performance. We like to put our money where our mouth is.
We've already bought all of these. That's the fun part.
Yeah. So the question is what do real estate investors really want? We're real estate investors like you. What do we really want? We want low risk. We want diversification. We want consistent monthly cash flow. We want low or no fees. And we want a team of actual experts that are actually in the field doing it, not somebody that's training and just asking for money to partner with another GP who partners with another GP who partners with another GP, and everybody's trying to pull together. And that's what we really put together for you. So I'm going to introduce it, the passive income note portfolio. This is the pitch while you're here on the webinar. It is the passive income note portfolio. This is a $550,000 tranche of land notes backed by desirable assets. Each one have been underwritten. Each one we've already bought with our own capital. And so, like I said, we put our money where our mouth is. These are 14 separate land mortgages and promissory notes, diversification. And you got 2 investment options, a 10% return for 6-month period and 11% return for a 9-month period. It's not a long lockup period. And then monthly payments begin 1 full month after investment. So today is March 27th. If you allocated and had all your paperwork done today, you would be getting your first check on May 1st. And that's, to me, is really cool when you're looking for an additional stream of income. And then the minimum initial investment is $25,000. It's relatively low. And this isn't our only offer. This isn't our only offering. We have offerings come up as we put the forced appreciation stuff in there. This is what's available right now, because our last 2 offerings, they sold out in less than 24 hours. The first one we talked about went full cycle. It took about a day and a half to 2 days to get that one full. I guess I can't say yet, but kind of sneak peek, the 3rd or 4th offering, our Kemp 50 is contract talk already. And I will say that our Comanche 188, if you're involved in those, the real estate agent was out there today while we had TxDOT out there, and TxDOT looked good. Real estate agent said she can't believe how good we got the place looking. So again, experienced operators, not just trained experts. That's it in a nutshell. And Nathan's got to ask a question here. I'm going to go ahead and go into those. Do we have any other questions feel free to put them in the chat. We'll answer that. We're here to have an open conversation with you. We really want y'all to get to know us. And then I have somebody anonymous here that wants to see the first page on the deck. So I'm going to answer Nathan's questions. We'll get to that as other people put in questions for us. Okay, Nathan, I have a question about septic. If these properties are for residential use, do you ensure septic can be installed prior to purchase? Is that part of your due diligence and market research? That's a great question. So what you're referring to is for septic, you're going to do what's called a PERT test to see if it can run. Texas, you have a lot of aerobic systems. We do make sure we're in compliance with the sizes that's going to require septic. And in the event that we don't have a good feeling about the soil type, whether it looks too rocky or not, we do bring out somebody to do a PERT test. A lot of the stuff we deal with in North Texas or West Texas doesn't have that problem. It will perk. Oklahoma's the same way. Really where it gets real dicey is when you start getting into east of the Mississippi, we'll run into situations where you have to perk it to plat it. So, but yes, that's a great question. And yes, we do take that into consideration. First page here. Let me get back there for you so we can get there. I'm assuming it's this one right here. And again, these numbers are just as us as a group collectively together. These are not our individual businesses that we've had. And so, which tells you one of the story we tell you is not a story at all. It's factual that we've been doing this together as operators, as joint, either myself and Trevor together, myself, Trevor, Josh, myself and Beth, Beth and Trevor, Josh and Trevor. We've been doing this together, and we've done this 4,300 acres developed. 21.6 million in revenue. That's what we do. This is what we do on a day-to-day basis. And I see a lot of the names in the attendees, and we've worked with a lot of you too. So I'm glad that y'all jumped on and spent your Wednesday evening with us. It means a lot to us. So one of the questions I had that came offline, I'll keep that up, was that how can you only lock up our money for 6 to 9 months and have a note that's 10 to 12 years? And it's a great question. So since we buy at a discount and you have the amortization schedule that involves in with a note, we're able to guarantee you those funds, but we keep some back and we use our own money to make sure that we have that there for you. So when we buy these notes, we're buying them at a 17 to 22% yield, which allows us to arbitrage into what we do for y'all and what we pay for y'all. And since we have already bought these, we're already flowing with them. The cash flow is there. And so we're ahead of the game right now since we started in August and it's now about to be April. So we're sitting on that principle and of those notes. One of
that's the key, Justin, right? That's the key is we've already bought it. It's not some pie in the sky deal, right?
This is not a dream. One of the Josh, who's our note guy, I say our note guy, he's more than our note guy. He's our chief operating officer. He says the thing he says is the worst thing that can happen to us in this fund is the person pays us. Now I want you to think about that right quick. The person does what the note says he's going to do. That's the worst thing that can happen. And the reason is because, like we told you, our KPI, we're at 56% of market value on these things. So if he does not pay us, we go through foreclosure, we resell it and capture 45% of that equity again. So that's the cool thing about that, and that's why the diversification is. So Jim Sessions, your question: 6 months, 10% COC, or is it 10% APR? It's 10% annualized. Thank you for clarifying that. And then are these notes all coming from your own projects where you're subdividing, or are they notes you're buying from other folks? Great question. Both. We have developed a niche, I'll say a niche, a following that we're willing to buy these notes at the closing table. So what we have are investors across the country. I want you to think about oil and gas leases, if you've been in that industry at all, is you have all these wildcatters out there putting these leases together. Then they put them together in one package, and then they tranche it out. We're the guy out there getting to these wildcatters and putting them together. And one of our levers on the back end is we do have some institutional partners that like the product we bring. And so they ask for certain seasonings, certain types. So the ones that fit their methodologies, we have the option to go to an institutional investor to open up the cash flow again, to open the tranche back up, go back so we can keep the ball rolling for either our own projects or for the wildcat investor out there that probably listens to Trevor's podcast, probably listens to Casual Fridays podcast, you know, there's somebody that we've worked with in the past because they know, like, and trust us.
But yes, that is the dream, and I've been sharing that with all three of us, right? Everybody else there is to be able to take that from a large unaffordable tract, subdivide that, force appreciation, hold that long term to have it all under one umbrella. Yes, that we don't do it on every single one because you're never going to do it on every single one. So a lot of people are just going to cash you out with other money, right?
Yeah.
But yes, that is the plan.
One of the cool things is, with us being actual operators that are running these businesses and going through it, we can get a good pulse of what's going on in our area. So these deals that we find, they're for forced appreciation, they come on market, off market, they come through our normal channels for our normal business. The notes kind of do the same thing. If they're in our project, we have the opportunity to sell them to the note. That way, we to the note fund at a discount, so it meets the KPIs that we want it to. We offer that out as a service where we have investors that will reach out to us when they put a property on the market and say, hey, this is what I'm listing for. This is what the agent says. Is this something you'll buy? So they know selling the property, they have guaranteed financing and they know what their cash flow is going to be. And when we talk about unpaid balances and it sounds really low, these investors are seeing anywhere from 85 to 92, 95% of what their original note balance was, because they get the down payment and then they get the cash influx from us and they go back out, buy more marketing, bring more deals back. And it's just a beautiful cycle of simplicity that, you know, like I said, we love. Great. Any questions I've missed so far? Anything else you want to touch on? Okay. You know, we do appreciate you spending your Wednesday evening with us. That was 30 minutes. I'm going to give it another minute or two to see if anything else pops up. Oh, okay. Sorry. So here we go. Are these deals 506C? Is there a PPM that can be shared? Yes. What we need for you to do is go register at Pasture Holdings. This is a 506C Reg D. The PPM will be there. And once you get registered in, you can see the PPM. No, we are not buying solely in Texas. We do buy all over. I think right now we're spread amongst 7 states on the note portfolio. Our deals right now, we have one that's we're trying to finalize, which would be offering number 5. Again, we like to give you heads up if you're a part of the webinars, if you're a part of the note portfolio, if you're an active investor in our other stuff, we kind of let you know before anybody else what's going on, so you can be first to pull the trigger. But we do have one in Oklahoma right now. But the last forced appreciation, the last 3 offerings for forced appreciation have been in North Texas, North and East Texas. What is your preferred process providing accredited investor status? Thank you, John. That's a good question. You can provide us with an accreditation form. If you don't have one, we can send it to you. Have your CPA, your attorney fill it out that says you are accredited. Or there are services that can do that that are attached to the dashboard when you go in and fill that out. Pretty simple. SEC requires us to update that every 3 months to make sure you still are accredited. So make sure that we keep that updated with us as you see the new offerings come in, because they do go fast. And I say that and I'm laughing and smiling about it because it puts me in awe when you talk about a $200,000 or $300,000 raise on a $500,000 place, and it's like that. It's the day you send the email, you have 5 people waiting behind, just say, let us know if somebody doesn't get their money in. So, but John, yeah, we can provide you the form. If you need, you can reach out to myself, Trevor, or Beth. We'll get it to you. If you don't have one, or you can use one of the online services that we have hooked to the Avestor platform through our investor portal. Cool, great questions, and I appreciate the coming through this, because this is recorded. People will come back and they will rewatch this later on. So feel free if there's anything else sticking out to you. If not, I'll give it about a minute, 2 more minutes. But again, thank you for spending your Wednesday night with us. We didn't want to keep you all night, but a good 35-minute webinar with you. We do appreciate your time. Great. Trevor, you have any final words?
No, that's the reason that everyone we close these out, is because we were a proven product, right? We've just all decided to team up and become a super team. That's we're turning into a super band, right? We've all had successful careers, and now we're coming together to make something really awesome, and we'd love for you to be part of it. That's really what we're doing.
That's perfectly said, man. I won't add to that. So we do appreciate you again. I think I had one more question come in. Thank you for your time, Nathan. We appreciate your time, sir. But if there's anything you can think of, feel free to reach out to us through the website, pastureholdings.com. I was going to do www, but I'm told that's not needed anymore. pastureholdings.com. and we'd love to spend some time. You can book a one-on-one call there, and we'll talk to you and answer any questions you don't want to ask in a public forum. But look forward to talking to you all soon, and can't wait to work with you.